Hi, today we're going to look at the basics of uniform rebalancing and how to implement it and apply it to the cryptocurrency market. And we will also look at Shannon's demon and see how it actually led to this whole idea of uniform rebalancing in the first place. So the concept of Shannon's demon is invented by the father of information theory, Claude Shannon, and he basically suggested a hypothetical scenario where you're basically playing a simple coin flip game, and you bet a certain amount of money, and if the coin comes out as heads, then you win 50% of your bet amount. But if it comes out as tails, then you lose 33% of your bet amount, and you basically play this game for an infinite amount of time. And so we can calculate the arithmetic and the geometric mean as follows. So the arithmetic mean, basically you multiply your probability of winning by how much you actually gain when you win, 50%, and the probability of losing multiplied by how much you actually lose, which is 33%. And the arithmetic mean of a single coin flip comes out to be 8.35%. So although the arithmetic mean is positive, this is quite misleading because it does not consider the compounding effect of gains and losses over multiple rounds. So in order to consider your gains and losses over the multiple rounds, it's actually better to look at the geometric mean. And once you calculate the geometric mean, then you realize that your long-term gains is actually going to approach zero. So in the next slide, if you see, this is basically how your portfolio value would look like over many number of flips. So it will basically oscillate back and forth, and it will keep on. It will be maintaining this state for pretty much eternity. Now, however, this outcome is completely changed if you, let's say, bet everything on every single coin flip. So instead of betting everything, if you rebalance 50% of your bet amount into cash after each flip, then you'll actually notice that your gains, your portfolio value, would be going up just as it's represented by this yellow curve. So why is this happening? We can analyze this from the perspective of CAGR, which is short for compound average growth rate of an investment, and also look into this concept of volatility drag. So CAGR is approximated by the average return minus the volatility squared. So as you can see, this volatility actually has a very large impact on your compound average growth rate. So when you bet the full amount each time, then your average return is higher, but your portfolio value is also higher at the same time. But if you move 50% of your portfolio to cash, you can actually reduce the average expected return, and the volatility is also cut down significantly. And so we actually result in a higher CAGR overall. So this is the whole idea of Shannon's demon. It's basically that instead of betting your entire amount, you basically rebalance 50% of it into cash. And we can extend this idea to portfolio rebalancing. So what happens is, let me give you an example. Suppose we are investing in Bitcoin, and our initial seed money, or our initial investment amount is $10,000. So on day one, as Shannon suggested, we don't invest the entire $10,000 into Bitcoin, but instead we invest $5,000 and we hold $5,000 in cash. And on day two, let's say our $5,000 investment dropped in value to $4,500. Then in total, we would have, instead of $10,000, now we have $9,500. So we redistribute the 50% of this amount to Bitcoin again, and we reinvest 4,750, which is 50% of 9,500, to Bitcoin, and hold 4,750 as cash. And on day three, let's say if the Bitcoin price went up, And in this case, we let's say hypothetically that we are at 5,600 for our investment. So from 4,750, we went from 5,600, and then in total we would have $10,350 of investment. So we put 50% of this back into Bitcoin. So we reinvest $5,175 and hold $5,175 as cash. So we basically continued this step, and Shannon suggested that we would have we would be experiencing this effect as shown by the yellow curve. So there are some practical issues when it comes to actually implementing this algorithm, right? And I'll talk about this more. But first of all, just now we dealt with a single asset, but we can actually extend this strategy to multiple assets. Suppose we're dealing with n different assets. And in this case, we can uniformly distribute our money into these n different assets, of course, including cash. So, for instance, let's say I'm investing in cryptocurrencies A, B, and C. In that case, let's say I'm starting out with $1,000. Then what I would do is I would invest $250 into A, $250 into B, $250 into C, and hold $250 worth of cash. And the next day, depending on how my money, how my portfolio value changed, I would rebalance it again uniformly. So theoretically, as the number of assets increases and rebalancing occurs over an extended period of time, the cumulative profit approaches the maximum potential for each asset. Now, this effect becomes more pronounced as trading approaches an infinite time horizon, which is, not really a practical assumption. So in real life, when we actually approach this strategy, there are a couple of things to think about, especially the rebalancing frequency, because if we rebalance too often, then it's definitely going to hurt our portfolio value because of simply the commissions, right? So I have implemented the uniform rebalancing code, and the links to these codes will be provided in the description. So I'm basically using an exchange called Bithumb, which is a Korean exchange, for me to test my uniform rebalancing algorithm. But you can basically use any other exchange after you read their API documentations. For instance, you could be using Binance, or you could be using MEXC or OKX or whatever, right? But the bulk of the logic is here, and applying this logic should be similar for it doesn't matter whatever exchange you're using. So I stated at the top of the code in comments that I believe that this strategy may be useful under two conditions. The first is that it's a bull market basically, so the altcoins are basically being pumped, and we are expecting like a cyclical pumping of altcoins. So what this means is that on day one, let's say altcoin A actually went up, but on day two, the funds that were in altcoin A moved to somewhere else, let's say altcoin B, and then altcoin B goes up. So if we expect this kind of cyclical pumping, perhaps uniform rebalancing might be a good strategy, right? So yeah, and I also stated here that I'm already holding large amounts of Bitcoin, ETH, Solana, so I decided to create a portfolio of cryptos that I have not yet invested, and each of these cover different sectors that I suspect will be bullish in this 2024, maybe 2025 cycle. So these sectors, I believe, are like RWA, AI crypto coins, meme coins, and the L2 sector. So what I did was, let me take you through the code. So there are two components. So this is specific to the Bithumb API. If you use an API from a different exchange, it'll be different, like how you use it. But basically, I'm using a wrapper kind of library called PyBithumb for the Bithumb API. And I obtained my API keys. This is the connection key and the secret key, I believe, from the Bithumb exchange. And for the record, if you are also going to use the Bithumb API, then this code is applicable to the API version 1.0. I do not think this is compatible with 2.0. So the assets that I chose, and this is in no way like an investment advice or anything like that. I just chose these assets for these different crypto sectors. So these two are like Solana meme coins, right? And this is the World Coin, which belongs to the AI sector. And this is the Ondo Finance crypto, which belongs to the RWA sector. This is Stacks, typical L2 crypto. And well, I'm not going to be using this variable, but then I've created another version of the code, which I'll explain a bit more later. So this is basically the number of assets plus one, because we are also considering a cash agent, because we're also keeping a cash balance, right? So basically, we uniformly distribute into 6 different assets. So 1, 2, 3, 4, 5, these 5 cryptos plus cash. And these are just utility functions to get, for instance, the current my current portfolio, my cash balance, and the current prices of certain cryptos, right? And this is, as I mentioned before, where the main logic lies. So you just have to emulate this step and apply it for other exchanges too. So the first step is, okay, so it's divided into 2 parts actually. There's the initial investment function, where basically you run this function if it's the first time running the program. So it just uniformly allocates your cash into each of these assets. So what you basically do is you get your cash balance, right? And then you compute the allocation for each of these assets. And then once you have this allocation for each of these assets, what you do is you obtain the price of each of the assets you're about to invest, and then you calculate the units to buy by dividing the allocation amount for each of the assets by the current price of the asset. And then you basically put in a market order. And I think the commissions for the market order was 0.04%. I might be wrong, but it's somewhere around there. But if possible, instead of putting in a market order, you could put in a limit order, right? So instead of market order, you can specify the price at which you want to buy as well, right? And so this is the initial investment, and this logic applies starting from the second trade, so starting from the second rebalancing step. So you've uniformly rebalanced it. Now what you do is when you're rebalancing, when the time to rebalance comes, then you sell all your holdings and convert them to cash. And this is the logic that does so. So you send in a sell market order for each of these assets. Afterwards, you recalculate the total portfolio value, and your portfolio value may have gone up or down depending on what happened, right, with each of these assets. So you basically obtain your total cash value, and then you calculate the new target allocation amount. Once you calculate the new target allocation amount, you can rebalance uniformly again based on your new target allocation amount. And this logic is pretty much the same as the initial investment logic that I explained above. And basically, this is it. It's a very simple program. And you run these logics within the while loop. And I haven't done any experimentation with this or any kind of optimization. I just assumed that a 5-day rebalancing period would be good enough. So I wouldn't recommend something. I wouldn't recommend rebalancing frequency that is too short. For instance, like something that's less than a day, right? Because the commissions are really going to hurt you badly. I think certain exchanges like MEXC, they provide. I think they do not charge any commissions for the spot market, but you would have to look into that. Yeah, so this is pretty much how this program works. And now there's a second version I'd like to take you through. And I named this version 2. And the difference between this version and the previous version is that I made this program such that if the difference, or let's say the differences in how much the asset prices changed, is less than 5%, then we don't necessarily rebalance that asset. So what this does is it basically tries to save up on the commissions from rebalancing too frequently, right? But on the other hand, it may start to deviate from the uniform balance of weights in the long run, right? So the difference lies in this part and in this logic specifically. So if the target allocation and the threshold percentage, if this is multiplied and if the difference is greater than or equal to this, right? Then you basically either buy or sell that asset. You basically rebalance it. But if it does not exceed the 5% threshold, then you basically don't take any action. So this is another alternative that you could look into. Now, this actually concludes the uniform rebalancing tutorial. It's a very short tutorial that I made. And there are many versions of uniform rebalancing actually, because right now we're using uniform weights, but then we can actually decide on which assets should receive more weights or less weight depending on certain formulas. For example, we could apply the Kelly criterion to this rebalancing method to decide the weights. Or if we want to go deeper down the rabbit hole, then we could also look into an area of learning called online learning. And over there, we can decide how much weight we will assign each of these assets using different methods, such as follow the leader or mean reverting or follow the loser or using nonlinear methods. So basically, maybe using deep learning to predict the weights for each of these assets, depending on which one the model predicts would go up more or basically go down in value, and so on, right? So it's an interesting experiment, and I believe it's something we can actually play around with, especially because I personally believe the bull market is actually close. It's just around the corner. So I'll be creating more interesting tutorial videos like this. Thank you, and I'll see you next time.